All right, so we're off and running for the review of Chapter 13, Accounting for Corporations. So thank you all for being here. First thing on page 492 talks about the corporate form of business, so you should be familiar with the three different organizational types: stockholders, board of directors, and the management, what they do, each of their roles. And then over on 493, there's advantages and disadvantages of incorporation. Now, I'm not going to go through and we'll talk about all those, but you should be familiar with the various advantages of incorporation, both the terminology and then what that means. So like the word and a short definition. You'll be seeing something like that on the test. And in the same way over on 494, you're going to see the disadvantages of incorporation. So there's probably about a dozen different advantages and disadvantages. You should be familiar with those. On page 494, it talks about equity financing. Equity financing is when you raise money for your corporation by selling stock. Stock and equities are the same thing. And so when you're equity financing, you're forming a corporation, you're selling stock to raise the money. Well, to do that, you issue stock, which is a unit of ownership. There's a couple of terms there that you need to be aware of about stock. There's something called par value, and PAR, that's the value that relates to the amount you say the stock is worth when you form the corporation with the state. It's a fixed amount. It hardly ever changes. It has nothing to do with market value or anything else. It's just a legal capital amount, because the second term is there is legal capital. And that's important because the state, when it gives you the right to have a corporation, is going to keep an eye on what's happening, and it's going to make sure you keep a minimum amount of capital in your corporation for each share of stock. That legal capital is the par value. So you usually want to set that fairly low. The legal capital is the number of shares that you've issued or given out to stockholders times the par value. You have to keep that minimum level of legal capital in your on your records in your equity section. If you don't, then the state's going to get grumpy and might make you put some more money in. The reason those are important is because those are terms we're going to use when we get ready to record the entries for the stock sale. So we need to know the par value because it helps us do the legal capital. Over on 495, they talk about the advantages and disadvantages of equity financing, which is using stock again. So you should be familiar with the different types of advantages and disadvantages, why you would want to use stock or why you wouldn't want to use stock to raise money for your business. Again, that's something you can probably expect to see. Some terms there, as well as knowing what the definition of those terms are, maybe being able to write out a real quick little sentence about each one of those items. Over in 496, we actually start getting into the accounting side as opposed to the legal side. And that's where we're taking a look at the different types of components of stockholders' equity. Unlike a partnership, which has a partner's capital, or a sole proprietor, which just has owner's capital, corporations sell stock, and so the money comes in different forms, and we've got to keep track of it in different accounts. So one of those accounts we have is called common stock, or if we sell preferred stock, preferred stock. Sometimes, though, we sell the stock for a price higher than the par value, and that extra amount goes into something called additional paid-in capital. So we have more accounts where we're recording the contributed capital that's given to the corporation by the stockholders when they purchase the stock. So you should be familiar with those terms. On 497, they talk about three different types of shares. They talk about something called authorized shares. These are the number of shares that you have. You get permission whenever you go to the state and say, I want to sell so many shares. This is how many they're going to give you for your corporation. Then you also have, after that, the issued shares. And then finally, you have the outstanding shares. Now, these are oftentimes the same. Issued shares are shares that have been given out or sold to the public or given in exchange for some value. And these issued shares are the ones the state wants to know that we are keeping our legal capital on. What gets tricky is that the outstanding shares are typically issued shares that have been given out and are outstanding in the public. So usually what will happen is that, say you go to the state and you say you want 10,000 shares of authorized stock, and then you give out 1,000 shares to different stockholders, and usually the outstanding shares are the same because once they're issued, they're outstanding, they're owned in the public. But what will happen sometimes is the company may buy back shares of stock. So we'd call those Treasury Shares. We're going to talk more about those. But Treasury shares are when the company buys its own stock back, and when that happens, let's say it buys back 100 shares, well, what's going to happen now is you only have 900 shares that are still outstanding. 1,000 shares have still been issued, but only 900 of them are outstanding. The reason that's important is because the outstanding shares are the ones that we calculate the dividend payments on. It's the ones that get to vote. It's the ones that we use when we calculate book value. So you always want to make sure you know what the outstanding shares are, because that's what you're going to use to calculate out your cash or stock dividends. So knowing those terms on 497 is good. They talk a little bit about preferred stock on 498, 499. All you really need to know on preferred stock is that it gets paid first, either if there's a liquidation or if there's dividends. The stock dividend, the preferred stock dividend that's given out is usually based upon a percentage of its par value. So lots of times preferred stock will have a preferred value that's a round number, like $100 par value, which just means that's what it's sold for. That par doesn't change, unlike the par value for common stock, which goes up and down, or which changes over time for the fair market value. And then you usually have a number like 8%. That just means that it pays an 8% dividend. Preferred stock is going to get paid a dividend before any common stock, but there's no guarantee they're going to get their money either. So you just need to be a little familiar with how preferred stock works on 498 and 499. And then we finally get to journal entries over in 501, where we're accounting for par value stock. Now, par value, again, is that amount that we told the state when we asked for the authorized shares. We ask it for the shares. They're going to say, what are they worth? We say, we don't know. And they say, well, give us a number. So we said, made up a number, $2 par value. We have to remember that number because that's what we're going to use to create our legal capital when we go through and put it into our accounting entry. So when we're talking about issuing par value stock, issuing is another way for selling or giving it out in exchange for something. So there on the bottom of 508, you can kind of see where they talk about going through and having sold some stock. So in this case, they say that we've issued stock, 5,000 shares of $10 par value common stock for $12. So if we look at our journal entry, I always like to go through when we have something that's involving cash and look at the cash side first because it's easier to take into account. So we know that we had 5,000 shares of stock that we sold for $12. So how much cash did we get? 60,000. So cash is increase or decrease? It's an increase. So if it's an increase, we're going to debit it. So cash is going to be increased, and so it's going to be the 5,000 shares times $12. Okay, that's the selling price. So that's our 60,000. Now, we told the state every time we issue some shares, we were going to keep an amount for legal capital. That was the par value. So we're going to keep that in an account where it's nice and easy for the state to find, called common stock. And so for every share of 5,000 we issued, we're going to multiply that by the amount, the legal capital we told them we were going to keep it in. Now in this case, on the example on page 501, the par value is $10. So we told the state every time we gave somebody some shares, we're going to keep $10 in the par value. So we go over here and we keep $50,000. So we sold it for more, and that's what we want to do, but in this particular case, we ended up with $50,000 in legal capital. So the difference is going to go into $10,000. It's going to go into an amount we call additional paid-in capital, or they just call it, yeah, they do call it additional paid-in capital there. So this amount here is always going to be like a plug. We find first how much cash we got, and then we take into account our legal capital, which will always be the number of shares that were issued times the par value, and then the difference between those is going to be what goes into our additional paid-in capital. Hopefully this number will be bigger because we'll sell our stock for a lot more than our par value. Especially as our stock gets older and more valuable and the company grows, this price will go up, the par value will probably stay the same, so this amount down here every time we issue new shares will grow. So that's how we account for issuing the stock. They talk a little bit about no par stock. Don't worry about it. It just means they use something called stated value, so just change the term stated to par and it's treated the same way. But something you do want to focus on is over in 503, where we issue stock for non-cash assets. Sometimes what happens is companies that are starting out don't have a lot of cash, but they have prospects and promise, and so they can convince people to take their shares in exchange for the product or the service. It's a great way for them to conserve cash. It also provides them with new people that can be potential investors in the future. So when that happens, we have the same entry for common stock and additional paid-in capital, but what we don't know is the cash amount because there isn't any cash. So how do we come up with our entry if we need this number and this number to find this number as a plug for additional paid-in capital? Well, that's the problem, is we got to find this number here first, but we don't have cash. So what we have to do is we have to look at what we do know. And so in the example on the bottom of 504, they talk about a company who had shares of stock they exchanged for land. And in this case, they had land. Let's say that the asking price for the land was $12,000. Okay? Now, do we just use what the people ask for, the $12,000, or what do we do with it? Hello. Well, what we're going to do is we have to use one of two choices. Our first choice is to use the value of what we gave up. So what we gave up is stock. As a corporation, we're giving out stock for the purposes of our company. So we look and see how many shares of stock did we give up. Well, if we go back here to our example on page 505, it tells us that we gave up 500 shares of stock. All right? We know we're going to get some land. We don't have cash. So the question is, what's it worth? Well, there's 500 shares. If we know what it's trading for, then we can use that to figure out what they accepted in terms of the value of the stock. So in this case, it says that they accepted 500 shares when it was trading for $16. So we know what our stock was worth. We know the value we gave up. And so if we take the $16 times 500 shares, that gives us $8,000. That's how much we could have taken those 500 shares and sold them for on that day that we did the transaction, and that would have given us that much cash. So even though they might have been asking for $12,000, they were willing to accept stock that was worth $8,000. So that's what we're going to show that we gave up. That's what we paid for the land, was the $8,000. And then we do the rest of our entry just like we did before. 500 shares, we have to put in the legal capital par value, which is $10. And so we end up with $5,000 over here, and then the difference between the two is our additional paid-in capital. So first we had to find this number. So our first choice is the value of what we gave up. But sometimes we don't know what our stock is trading for. We're brand new, we're a company that nobody has bought any stock, or we don't have any value, so we don't know the fair market value. So we don't know what to multiply. We don't know this piece right here. Well, in that case, we have to fall back to plan B, our second choice, which is if we don't know the value of what we gave up, we have to assume the value of what the people told us that service or product was worth. So in that case, we would go over here and say, well, they're asking $12,000. Since we don't know the value of our stock we're giving up, I guess we're going to have to use the $12,000. So we would put the $12,000 in, and then we would do our calculation. It's still 500 shares at the par value of $5,000, but now the difference is going to be the $7,000 we need to balance the entry. So that's not our first choice. That's our fallback. But if we don't know the value of our stock, what it's trading, because that's a question and a fair market value, then we have to use this option. So that's something you probably want to keep an eye out for. Okay. Over on page 505, they talk about something called treasury stock. Okay. Treasury stock's kind of a little bit different, because what treasury stock is where the company, as I said earlier, has sold or issued its stock. It's sold it to stockholders. And so now it's outstanding stock. It's common stock. It's been recorded here. That 500 shares has been given out to people. They're buying and selling it. And then at some point, the company has decided it wants to take some shares back, to buy the shares back. It's going to actually pay cash for those shares, just like if it was some other investor buying stock. And so when that happens, though, the company can't own stock in itself. It can't vote its own shares. It can't pay itself dividends. And so what happens to those treasury shares? Well, what we do is we go through, and instead of, if the company buys back shares of stock, instead of reducing the common stock account, we don't want to mess with the common stock or additional paid-in capital accounts that were created whenever we first set up the stock. Because this is what the state's looking for when they see our annual report. They want to make sure we've got our legal capital in there. So if we tell them we got this many shares issued, and we turn around and change our minds and buy some shares back, it's going to confuse the state. because those shares are still issued. They're just no longer outstanding because they're not owned out in the public. We now own them. So we use treasury stock as a separate account to show the value of the stock that we purchased. And we don't mess with our common stock or additional paid-in capital accounts. So what happens is, over on page 506, you're going to see there an example where we go through and we bought back some of our shares. In this case, the company has purchased 2,000 of its shares, and it's buying them back. The reason it does that is to usually reduce its equity, so it calculates a higher ROE, or return on equity, for the company, and it reduces dilution and some other things you probably read about in the chapter. So why do we do this? Well, we go through and how we record it. The first thing we're going to do when we have the stock, in this case, we purchased, 2,000 shares at $50. So there's 2,000 shares, and we paid $50 purchase. Now, the first thing you need to remember about treasury stock is that we always record it at cost. This was our cost, because we need to keep track of how much we paid for it. So we're going to put it in an account called treasury stock. We're not going to do anything with the common stock account. These 2,000 shares were originally common stock that had been sold. It was issued and outstanding. We're buying it back, so it's no longer outstanding, but it's still issued. So we don't want to change that legal capital issued thing for the state, or we'll confuse them. So what we're going to do is we're going to put it into an account called treasury stock. We're going to take the 2,000 shares, multiply it by what we paid for it, and now what we have is $100,000. Since we paid for it, what do you think the other side of the entry is? Cash. Now that makes sense. The cash went away, so the asset went down. That's a credit. But why are we debiting a stock account? Well, what this is an equity account. It's like a contra equity. It's the opposite of an equity account, because this is reducing our total stockholders' equity. And actually, if you go over and look on page, I can figure out where my contributed capital was. If you look on page 496, on that little green Exhibit 2, you're going to see there that it says less treasury stock at the bottom. You're subtracting that $40,000 from the amount of the total contributed capital to show your total stockholders' equity. So this is a negative stock account, if you will. It's a debit in an equity account. So it's reducing our total equity. And then what happens is we always keep track of this $50. So we want to make sure we record what we paid for it, because if we sell it later on, we need to take it out at that same price. There's no par value here. We're not worried about par value. We're just focusing on what our cost was. Now, they talk about selling it over on page 507, selling it at a price that's higher. So in this particular case, they roll it out. We bought this on September 9th. So on, what is it, November 15th? November 15th, I mean. We go through and we decide to sell it. So we sell it for more. We sell half of it, 1,000 shares, for $60. So our cash is $60. So we sold 1,000 shares at 60. The treasury shares, we put them in at 50, so since we put them into the account at 50, we have to take them out at 50. So the treasury stock, we go through and we take out at 1,000 shares times the $50 cost. The $10,000 we need to balance, it becomes an additional amount. It's extra money we got in. So it's also treated as additional capital, paid-in capital, but we don't put it in the one that's with the common stock. We put in additional paid-in capital treasury stock. And so it becomes a separate account. Still an equity account, still shows an increase. But we put it in there so that we can show that we got the money. Now, if nothing else happens, it just stays there. That's just extra money. It's an extra $10,000 that we got for the equity and the stock. Later on, if we sell it at a price that's less, because sometimes we might take it out and sell it for less than the $50. Well, if that's the case, when we take it out, we have to take it out. If we'd ever sold it for more, we take that money back. If we don't have any money that we sold in the past, we don't have any additional paid-in capital, or we have more that we sold it at a lesser amount than we had the $10,000, then the difference comes out of retained earnings. But what never happens is you never go through and show a gain on your own treasury stock. There's never an income or gain on the sale or loss on the sale. GAAP rules in the U.S. don't allow companies to have gains or losses on their stock. So we always have to put it into treasury stock at cost here, and then we take it out when we sell it, and if there's more, it goes into additional paid-in capital. If there's less, it comes out of retained earnings. Okay? So that's a little bit about treasury stock. Okay. This is probably a good time to take that break for this. So